Marc Faber, Managing Director of Marc Faber Limited and the publisher of the Gloom, Boom and Doom report, and of course is the Managing Director of his own investment firm. Marc, good to have you on the program. So no sigh of relief from you, considering we have new leadership in Europe.
Well, I think the market was oversold and we are rallying now, but basically there's not much change. But I'd like to say this. I think sooner or later the Europeans, specifically the ECB, will also have to monetize, and therefore the problems can be postponed for a while.
Okay, problems are postponed for a while. What does that mean for equity markets? Because we are seeing a rally today, but you don't think we'll make new highs in the next 6 to 12 months?
Well, I think it's going to be very difficult for markets to make a new high above. In the case of the S&P, May 2, the S&P at 1370. I think there's a lot of supply between this level here, 1260, to around 1350. So I doubt we'll see new highs. But it doesn't mean that the market cannot rally another 5% or so.
Okay, well, taking a look at your asset allocation, Marc, 25% in equities, 25% in cash, 25% in real estate, 25% in precious metals. To me, it sounds like you don't really have a view right now on the markets. Are you a bit confused?
No, I have a view. My view is that nobody knows, because markets now are very volatile, partly because interest rates are at 0% and in real terms negative, which essentially stimulates speculation. And in addition, we have high-frequency trading that leads to very wide swings in markets, because the high-frequency traders are basically based on models that are momentum-like models. In other words, the market moves up, everybody goes long; the market moves down, everybody goes short. And what we had is a peak, as I mentioned, on May 2nd, 1370 on the S&P, and then we went down sharply in late July, August, and bottomed out on October 4th at 1074 on the S&P, when everybody turned negative, and afterwards we had again this very sharp rally of almost 20%. And I think this rally may carry on somewhat, and that the super bears that think the S&P drops to 400, for the time being, they will have to go into hibernation.
Yeah, okay, well, they have to feast before they do that. Marc, okay, so if you think that we're going to see maybe a bit of a rally here, how long do you think this rally might last on the markets?
Well, I think that usually the second half of the year and the first few months of the new year are periods of seasonal strength. So it wouldn't surprise me to see the market rallying until February to April, and then starting to sell off again in 2012.
Oh, wow. Okay, so falling off in 2012. All right, so let me just ask you one more question, Marc. Okay, so we have 25% in a lot of diversified assets. Do you think we could see that lows retested again before we get into the, I guess, the year's end?
That I doubt. I think maybe we drop to around 1200, but I think there is now quite a lot of support on the S&P around 1230, 1240, and that new lows below 1074, which were reached on October 4th, is most unlikely. I also happen to think that the Asian markets have bottomed out for the time being, that they'll rally, but no new highs.
Okay. Well, Marc, before I let you go, talk to me about allocation. Would you say you're more bullish on Asia than you are on the rest of the world, or do you like the U.S. better, or maybe you're brave enough to, go into Europe as well?
Well, it's funny that you're asking this, because if I look at the volatility we had in markets, and the result is actually that the S&P and the Nasdaq are flat for the year, whereas the European and Asian markets are down between 10 and 20%. So this year, the U.S. market has actually outperformed many other markets, and I think this outperformance may continue for a while, because in the U.S. you have guaranteed extremely expansionary monetary policies with zero interest rates staying there essentially forever, because the new thinking at the Fed is that they will keep interest rates at zero until the unemployment rate drops below 7.5%. Now, this may never happen, because as in the Middle Age, when we had village idiots, we have today a lot of unemployable people. So the natural unemployment rate may be in modern society around 10%.
Okay, Mark, well, thank you so much for your honest and frank
pleasure.
insights there.
It's my
Good
pleasure.
to see you, Mark.